So thank you very much. Thank you very much for the organizer to including this paper in this very nice conference, and actually fits very well in this session and links very nicely to the previous paper. So this is a joint work with Anna Pereira, Mara Pirovano, and Florian Stammwitz, and it's called From Losses to Buffer, Calibrating the Positive Neutral CCyB Rate in the Euro area. So we are really talking about macroprudential policies and countercyclical capital buffer more specifically. Since some of us work in central banks, the usual disclaimers apply. Okay, so what motivates us to work on this topic? So in the recent period, especially since the pandemic, an increasing number of EU jurisdictions have introduced a framework for the positive neutral CCyB in their countries. And specifically now in the EU, we have 16 countries with a positive neutral rate, which is a fairly high number, considering that this has happened mostly since the pandemic. So what do we mean when we talk about positive neutral CCyB specifically? So when we refer to this as setting a positive rate for the CCyB when cyclical systemic risks are not yet elevated. And why authorities are using the CCyB in this way? First of all, they want to have a higher level of releasable buffers. And this is mainly due to increase the resilience against a wider spectrum of shocks. So going beyond essentially the risks stemming from cyclical domestic imbalances, but also to address potential under-calibration of the CCyB due to the difficulty of measuring cyclical domestic risk, which is far from being trivial. So despite there was this increasing number of adopting countries, the analytical toolkit to inform the calibration of the positive neutral CCyB is still under development. And so what does this paper do is essentially to propose a methodology to calibrate the positive neutral rate in the euro area. So where do we sit in the literature? So the literature on the CCyB calibration is quite wide and includes various different approaches. So from risk indicator-based approach to structural macroeconomic models. And our paper is very much related to a strand of literature which adopts stress testing and analysis of bank losses. In particular, it's very close to the two contributions like in Langen, Forletta, and Pasini and Pereira, 2020 and 2023. What we do is essentially to use a very similar framework as of these two contributions, and we integrate that calibrate the CCyB and integrate a calibration for the positive neutral rate. So what is the idea of our excuse me, approach in a nutshell? The main idea is essentially to study, to analyzing the risk, the return on assets, the bank return on assets, and disentangling the impact on bank return on assets of various factors, and essentially mapping these factors on calibration of the CCyB. In particular, we study the impact of cyclical systemic risks on return on assets, and we use this information to calibrate the CCyB when risks are elevated, when cyclical risks are elevated. We study quantify the impact of unobserved systemic risk factors on the ROA, and we use this information to calibrate the CCyB when cyclical systemic risks are not elevated. And at the same time, we control for a number of bank-specific and country-specific characteristics in order to control for those factors that are typically used to guide the setting of other micro and macroprudential capital buffer. So the ultimate goal of this paper is to essentially propose a unified framework to calibrate the overall CCyB through the various phases of the cycle, including when cyclical systemic risks are not elevated. So as a preview of the results, the positive neutral rates that applying this framework on euro area data are range between 1 and 1.8%, depending on policymaker preferences. And on this, I will be a bit clearer in a second. So let's jump into the model. A few words on our variable of interest, so bank's ROA. Two observations about this, the distribution of bank ROA in the euro area is that first it displays a fairly, the unconditional distribution across bank and time displays a fairly long tail on the left side compared to the right side. And second, if we look at the behavior of the distribution of the bank's ROA through time together jointly with an indicator of domestic cyclical risk for the euro area, which is taken by a paper by Lang et al. In 2019, which is a composite indicator which essentially capture domestic cyclical dynamics. Essentially, what we see is that following an increase in domestic cyclical risk given by the red line and the right-hand side chart, we see really little movement in the median of the distribution that is given by the dark blue area, while we do see a shift in the left-hand side of the distribution, so in particular the lower percentiles of the distribution following an increase in cyclical systemic risk. So we see the 25th percentile going down. So it seems that systemic risk predicts shift in the distribution of the return on assets. So after observing this analyzed fact, we thought that it was more interesting to look into a model that that allow us to capture different effects on different quantiles of the distribution. And so we use more specifically a quantile location scale model, and we combine this with a local projection. And in this, we are very similar to these two works that I was mentioning before, because they also combine quantile models with local projections. And specifically, our model is as follows. So we modeled the quantile tau of the bank's ROA as a function of, as I said, domestic cyclical systemic risk given by the DSRI indicator, plus an interaction term of the DSRI indicator and the Tier 1 ratio, which essentially captures the idea that the impact of an increase in systemic risk changes depending on the capitalization of the banking system. And then we control for a number of bank-specific and country-specific factors given by X and Y. And we include in the model as well bank-level fixed effects and time fixed effects, which are given by alpha and lambda respectively. And then this will become relevant, especially the time fixed effect, when we need to calibrate the positive neutral rate. So which are the benefits of this modeling approach? So first of all, as I said, it allows to capture potential nonlinear responses on bank losses or bank profits across the various different percentiles of the conditional distribution. The local projection frameworks allows us to study the impact of the variable of interest on different time horizons, including those that are more relevant for policy making. So in general, the framework is flexible enough to include policymaker preferences. And more technically, the quantile location scale model compared to other quantile models approach avoid incidental parameter problems and quantile crossing. And this, it allows essentially to include bank fixed effects in the model, which we believe is very important when we study the determinants of bank profitability. So we source our data from SNL Financial. Our samples span from 2005 to 2009, and we take banks at the highest level of consolidation, and only those banks which have data available for 2008 and 2009, because we believe this is an interesting period to look at. And the number of bank level characteristics that we include in the model are essentially aimed to capture bank size, bank capitalization, bank asset quality, cost efficiency ratios, and so on and so forth. And at country level, we include the GDP growth rate to capture the business cycle, the yield slope in order to capture the monetary policy stance, and the DSRI that, as I said, it captures the domestic financial cycle in each country. So we cover overall 318 banks in our sample, and overall we consider the data coverage to be quite satisfactory. It covers around 80% of total assets in the consolidated euro area banking sector. So a quick note on the estimation. So since, so as I shown, we have, our sample is such that we have a relatively small t, a small time dimension, and a quite wide cross-section. This leads to the problem that the estimator that we use is shows a bias in the parameters. So essentially, our estimator delivers parameters that is essentially biased with a bias term which is proportional to 1 over t. So as t decreases, our bias increase. And in the paper where this estimator is proposed, essentially is shown that applying a split sample jackknife procedure substantially decrease this bias. So what we do is essentially to implement this procedure and recenter the confidence intervals around the bias corrected estimates, which is shown to also improve substantially the coverage of the confidence interval. So the results. So we look at the marginal effect of the DSRI on banks' ROA across different percentiles of the conditional distribution. So a few remarks on the results. So first of all, after an increase in the DSRI, so in a cyclical systemic risk, we observe a negative impact on banks' ROA. Regardless of the percentile of the conditional distribution we are looking at. In terms of the magnitude, we have a peak effect which is fairly similar again across percentile, and also like the shape is the peak effect occurs in all cases around the fourth year of the projection horizon. So here we project on over 6 years, and what the only difference in the shape that we observe, even here are not shown the results, but if we look even more on the left of the distribution, so at lower percentiles, what we see is that essentially the rebound of the ROA, the recovery seems to be slower as we go on the left of the percentile of the distribution. We also observe a higher level of uncertainty in the estimates around the lower percentiles, and this we essentially explain mainly by the fact that in the lower parts of the distribution we have higher sparsity in data, and this leads to less precise estimates typically. So we're not too surprised to see this. So now, how do we use these results for calibrate the CCyB? So first of all, we use the coefficients. So we focus on the CCyB essentially in the higher part of the cycle, so to address cyclical systemic risks. And in particular, we use the estimated impact of the DSRI on banks' ROA at the relevant horizons. So when I say the relevant horizons, I refer to essentially when the impact is the strongest. So we take the coefficients associated to the third to the fifth year of the horizons, and we combine this with the coefficients associated to the interaction term, and is evaluated at the average T1 ratio. We multiply this for the level of the DSRI in each country and time, and we essentially divide this for the average risk-weighted assets in order to convert our coefficients in the units of CCyB as it is required by the regulation. And so the results of the implementation of this linear rule delivers results that are varying across countries and time. And what we can see here is that essentially, if we here are shown just 4 countries as an example, and so if we look at all the 4 pictures, what we see is that in the first part of the sample, we have a positive level of CCyB, regardless whether we take the 50th of the 10th percentile, which are given by the dark blue bar and the combination of the two respectively. So in the first line, in the first row, both countries, as I said, has a positive level of CCyB in the first part of the sample, where cyclical systemic dynamics, where cyclical systemic risks were elevated because we are before the great financial crisis. And as soon as the great financial crisis happened and the domestic cyclical risks do materialize, and so dissipates, essentially the framework suggests a release of the rate. And then towards the second half and the end of the sample, essentially the calibration rule suggests a build-up of in the CCyB again. While this is not the case in the countries in the second row, Italy and Spain, where essentially in the second part of the sample we observe subdued domestic cyclical dynamics, and so this is consistent with essentially what we observe the negative, zero level of buffer rate suggested by the calibration rule. Okay, so now we go one step further, and we calibrate. We offer a calibration for the CCyB in times where cyclical risks are not yet elevated. So in order to calibrate the positive neutral rate, we need essentially two ingredients. One is a target rate, which is the level of buffer at which essentially to achieve at which the authority set the rate. And then we need a build-up rule. So a set of rules essentially that guides the speed at which this rate is built up, and then the conditions where that govern essentially the release of the rates. So the target rate we want to be high enough to offer enough loss absorption capacity, and we focus on a unique target rate across euro area. And we provide here a range rather than one individual buffer in order to accommodate different policymaker preferences, meaning that we look at different buffer rates resulting from different percentile targets, essentially. So in practice, what do? We use the estimated time-specific fixed effect, the coefficients, the estimated coefficients associated to time fixed effects in each year at the relevant horizons, and according to the following rules. So we take the non-negative values of the coefficient, estimated coefficients for the time fixed effect for each percentile tau, only those that display statistically significant values. And again, we divide these values for the average risk-weighted assets to account for essentially to convert these coefficients in rates of positive neutral CCyB. So in terms of the percentile selection, we select in this exercise the 25th and the 10th percentile, because essentially we want to move towards, we want to focus on the left side of the distribution, of the conditional distribution, but at the same time we want to avoid the tails for two main reasons. First, because we want to avoid potential overlap with what is already covered in P2G, which tend to cover essentially losses coming from extreme negative scenarios. And also, as I said before, technically speaking, if we go too much on the extreme tails of the distribution, then the precision of the estimates tend to decrease due to higher data sparsity. In terms of horizon selection, we select 1 year ahead in order to account for the implementation lag of the CCyB, which is 1 year. Why do we think that this makes sense? So time fixed effects, essentially the coefficients associated to time fixed effects are invariants across banks as opposed to being bank specific, aligning with the goal of capturing unobserved factors that simultaneously affects all the banks in each period, and that are not at the same time accounted for in the essentially other elements of the model. And this is consistent with the concept of the positive neutral CCyB in our view, first because this is an instrument which is macroprudential in nature, so it's set to address systemic risks as opposed as bank idiosyncratic risks, and also because it aims essentially at increased banking sector resilience against those losses which are left uncovered by other buffers, so or by the CCyB itself, but in times of higher cyclical domestic imbalances, or because essentially the uncertainty of measuring cyclical systemic risks. or because they stem from risks that are different in nature and that are not envisaged to be covered by other policy instruments. Okay, so the resulting target rates are the following. So for the 10th percentile, we obtain a 1.8% CCyB. For the 25th percentile, a slightly higher rate than 1%. Here I'm also showing what would be the results if we looked at the median, and this would be significantly lower, around 0.3%, which is not surprising because essentially when we look at the median, it's normal that unobserved components, unobserved factors tend to explain a much larger share of events that are rather on the tail than on the median. So we think that it's not too much interesting case to look at. So, as I said before, we also need a build-up rule to decide how fast we build the buffer rate, how fast we get to the target rate. And here we really throw an example, a very simple example of a build-up rule, but it's purely illustrative. It's just to essentially have an exercise where the buffer rate varies across countries and time. The condition for the build-up, maintenance, and release are set in a way that essentially the build is built up when there is a high level of profitability in the banking sector and low financial distress. Why so? Because essentially we wanted the main scope, the main goal of the speed at which the rate is built up, it should be to minimize costs of increasing buffer rates in terms of lending and GDP. And low financial distress is typically followed by macroeconomic downturn, so we do not want to essentially to be procyclical. So as I said, this is a purely illustrative example of how the build-up would look like, but it's not really the main focus of the paper. Here, as I said, then the framework provides a calibration of the overall CCyB through the cycle. So both in times of high and low cyclical systemic risk. So in the first row, we see an example of two countries that over in the sample considered have displayed low level of domestic cyclical risks, and yet we have the calibration suggests a positive buffer for the CCyB. In the second row, we have Italy and Spain that we already seen before, that in the first part of the sample have high domestic cyclical risks at play, and the level of CCyB overall would be higher if we had considered only essentially the CCyB to address cyclical systemic risk, because now we have in the overall calibration also the positive neutral part. Moreover, and most importantly, in the second part of the sample, despite cyclical domestic dynamics did not pick up, the rule, essentially the calibration framework, suggests still to have a positive buffer for the CCyB, reflecting the fact that bank profitability have picked up, and so increasing bank capitalization would have come at low cost. We ran a number of robustness checks, which I will not go through one by one, but overall the results seems to be robust to the above test. And with this, let me conclude. So this paper proposed a novel framework for the calibration of the overall CCyB through the cycle. We do so by disentangling essentially the impact on bank profitability associated to the financial cycle and to other factors that are not necessarily related to the financial cycle. Our framework proposes an harmonized calibration approach for the positive neutral CCyB, but at the same time accounting for country-specific conditions. And it delivers, as I said, a calibration of the overall CCyB across countries and time, and at the same time accommodating policymaker preferences. Thank you very much.
Thank you, Giorgia. Thank you. The discussion is by Manuel Muñoz from the Spanish Treasury.
Well, first of all, I would like to thank the ECB and the organizers for their kind invitation. It's a pleasure to be here as usual. So today, in order to discuss this very interesting and timely paper, I'm going to follow a not very standard approach. I think it's the first time I'm going to do this. But in order to make several of my points, I'm going to refer, as you will see, to a recent paper of mine with Frank Smets titled The Positive Neutral Countercyclical Capital Buffer, which will be out next month, because I think it's going to be very illustrative to see what I'm referring to. Given that Giorgia greatly summarized the paper, if you allow me to, and in the interest of time, I'm going to skip the summary and I'm going to jump directly into the comments and mostly questions that I have for the authors and for the audience. Before that, I would like to touch upon the motivation behind the decision made by several central banks in recent years to set, by revising the CCyB framework, a positive neutral rate and or an early activation procedure for the CCyB, which in my view basically builds on the evidence and experience related to the COVID-19 crisis. And the reason is basically twofold in my view. First, based on several empirical studies, we know that the release of the CCyB in extraordinary crisis times can significantly contribute to sustain bank lending to the real economy. And second, current CCyB frameworks, at least envisaged, those envisaged by the Basel III Accords, may not ensure enough macroprudential space to release the CCyB when it's needed the most, right? And that's what we realized in the outbreak of the COVID crisis. And due to this reason and other aspects and dimensions of the design of the Basel III framework, we eventually resorted to really unconventional and emergency tools such as the dividend or system-wide dividend restrictions. Now, so in order to make the 4 points I just want to make here, I have listed 4 key questions that in my view are currently on the table and being discussed by policy institutions with views, among others, to possibly think and consider a future reform of the EU macro-proof framework, also along this dimension. So the first question is when to build a buffer. You know, and in order to touch upon this point, let me ask you the following question. Was the recent interest rate hiking cycle the right time to build the CCyB? Well, from the macro perspective, one would argue that that was not the case, because in most jurisdictions, the credit to GDP gap was in negative territory, and this and other shocks may have adversely affected aggregate demand through its impact on lending. Now, by way of contrast, from a bank profitability perspective, precisely these and other shocks boosted bank profitability, thereby giving more headroom for banks to improve bank resilience by building these buffers, and by building them precisely when it is less costly to do so. Now, as Giorgia mentioned, at least in one of their illustrative exercises, they upfront made the assumption that implicitly a bank profitability indicator, the return on assets, is going to be the main guide or the main indicator that is going to guide CCyB decisions. In my paper with Frank, we basically saw for a variety of bank profitability indicators and macroeconomic indicators, including the credit to GDP gap, that guiding CCyB decisions over the cycle with bank profitability indicators can induce large welfare gains, as opposed to the case of macro indicators, including, again, the credit to GDP gap. However, we have to distinguish between business cycle frequency and extraordinary crisis times. It is in extraordinary crisis times when we want to release the buffer, and in those cases in which the economy moves to another state of the nature, we may want to focus more on the macro environment and the state of the economy rather than on the bank profitability indicators themselves. So it's not clear that we should use the same indicator as a key references in all different states of the nature. My second question is how to build a buffer. The authors come to a conclusion which I like a lot, which is that because of the fact that there's a lag in the impact of cyclical systemic risks on bank losses, one should build this buffer in a forward-looking manner, meaning highlighting the importance of the early activation of this tool, which is in line with many academic results and in line with the views of many policymakers. Now, however, to be more specific, in my work with Frank, what we find is that even if the different bank profitability indicators as guidance for CCyB decisions can induce significant welfare gains, alternative indicators such as the net lending margin and the bank return on equity, because they capture better than the return on assets the bank profit generation capacity, they have the potential to induce significantly larger welfare gains via the CCyB than the bank return on assets. Third, which type of systemic risks is the CCyB really expected to manage? Very accurately, the authors basically calibrate what I refer to as the cyclical component, or the traditional, if you wish, counter-cyclical capital buffer, on the basis of cyclical systemic risks. Whereas, if I understood correctly, they calibrate the positive neutral CCyB on the basis of what is not observed with observable variables used in the model. So it's kind of calibrated as a residual after I have accounted for the different observables and its implications for the calibration of the other different components of micro and macro capital requirements. I didn't find that fully satisfactory because this positive neutral rate should be envisaged indeed to also manage cyclical systemic risks. And if you agree with me, at least to some extent, then the other question would be why annual data are not higher frequency data, such as quarterly data, if indeed we really care about cyclicality. And I would go for that, even if that comes at the cost of restricting the very nice sample size you have in the paper. And my last point on this third question directly relates to my fourth and last comment or question, which is, should the buffer depend on national specificities? Another key policy question on this topic nowadays. In my work with Frank, what we find is that the size of the optimal positive neutral and the associated welfare gains, and by the way, we develop a macro banking model with bank risk failure and binding borrowing constraints in the real and the financial sector of the economy. So it's very complementary to the empirical approach followed by these authors. We find that it increases with the aggregate volatility of the economy under consideration and with other structural factors such as the share of firms facing binding borrowing constraints associated to asset prices such as property prices. Now, I found quite striking that when you look at these figures 6 and 7, we find when you look at the secondary y-axis, you see that for relatively more volatile economies such as Spain and Ireland, you see the yellow dots, cyclical systemic risks around and before the COVID-19 period were lower than for other, in principle, less volatile economies such as France and Austria. And as a result of that, you find that the CCyB that should have been built in those years in less volatile economies should have been larger, whereas for Spain and Ireland, one should have not built a buffer before that crisis whatsoever, in a context in which, as you know, some of these central banks have argued that precisely because they have relatively more volatile economies, there's a role for this positive neutral rate for the CCyB. Okay, so in the interest of time, I'm going to leave it here, but I would like to highlight again that this is a very timely and important paper based on a very useful approach, which is based on a quantile regression model. So it focuses on tail risks to manage or to calibrate macro bank capital tools, which is the adequate way to go. I just believe that there's a few points one could touch upon in order to make the contribution even more useful for policymakers. Thank you very much.
Thank you very much, Manuel. So the floor is open for question. Bruno.
Thank you for this great presentation on discussing further these optimal levels of capital requirements. So before I saw the presentation, I thought you would be discussing this important question on a cost-benefit analysis. So I agree with Manuel that you look at return on assets. I think return on equity would be more appropriate, but then I would also look on the other side, the cost of equity. So at the end of the day, this is a cost for banks, right? So you are strengthening the financial sector and banks, but there is a cost of issuing more equity. And banks will do that because they will comply with the requirements from the regulator, but that's costly. So why didn't you consider that? And because it's costly, and more so for some banks, they may not use it in the future, those buffers. So that's the idea, right? You have a shock and you want to support credit, and banks will, the regulator releases the buffers and they use it. But if it's costly, they may not be. So this is a question. Then I have a comment on thinking about alternative tools. Maybe it's behind the scope of the paper, but I was thinking about the experience of Spain with dynamic provisioning, kind of predecessor of CCyB. There is this paper from Jimenez and co-authors that they find distributional effects, right? Smaller banks were more affected and smaller borrowers. So as you know, the US doesn't have CCyB. They have stress test-based capital requirements. So you can, some of the banks might need to rebuild buffers, those that really need them, and maybe not others. Whether this is something that could be also considered instead of a CCyB for everyone. Thanks.
Jean-David?
Just a quick question, maybe it's beyond the scope, but are you encouraging risk build-up with the CCyB? So, I mean, I get is this buffer that is the same for all banks, regardless of the contribution each bank to the systemic risk. So wouldn't it be privately optimal just to take as much risk as possible, or less equal? Thanks.
Caterina?
Caterina Mendicino, ECB. Giorgia, I wanted to ask you, what is the sensitivity of the calibration of the neutral CCyB to the interest rate environment? The reason why I'm asking you this is because in my JME paper with Javier Suarez, Karin Nikolov, and Dominic Supera, we saw that monetary policy is relevant for assessing the cost of increases in capital requirements. And in a follow-up paper with Valerio Scalone, which is also here, we also saw that this is a relevant margin for the impact of CCyB buffers. So I wonder if in your framework you have any consideration on the sensitivity to the interest rate environment. Thank you.
Any other question, comment? Livio?
No, thanks. Two questions which are partly related to the discussion. So the first is, so I understand that you use losses. You made the local projection regression on losses. I just wanted to ask, what kind of losses are these? Because it's tricky to measure losses. Is it going concern losses, going concern losses? I mean, do you include both? and the measures are, maybe very different. And the second question, I was surprised that you didn't mention also the limit to releasability. So the fact that if you release, then you may end up, hitting the leverage ratio and so on. So you don't consider at all these kind of limits to releasability. Thank you.
Okay, I would close it here. So maybe Giorgia, I would say you have, I don't know, 2-3 minutes to answer the question.
Okay, thank you very much. So thanks a lot, Manuel, for the really excellent discussion, really insightful and interesting. So a few, let's say, answers to your points. It's true that we mainly, come from a place where we think about the positive neutral CCyB to cover a wider spectrum of shock going beyond the domestic cyclical risks. But we also believe that in this framework we can, taking the time fixed effect and considering there is always some chances that despite including measures of domestic cyclical risk, there is always some chances that you are mismeasuring this type of risks. By taking the coefficients of time fixed effect, this would be captured in it. So essentially, on your concern that you should also address some residual domestic cyclical risks with the PNR that you're not capturing because of with the CCyB, because of the mismeasurement of domestic cyclical risk, we do believe that this is essentially covered and taken into account. And actually, in fact, if you look at the time fixed effects in the years around the crisis and after the crisis, this is, they are, this is when they are actually the highest. So essentially, despite we are including an indicator for domestic cyclical risk. So we believe that, we agree with you that it should also include some, should also be there in order to address potential under calibration of the CCyB due to mismeasurement of domestic cyclical risk. So we do believe that this framework takes this into account, but it's a very great point. And also in terms of on your comments on the charts, so you do see zero level of the buffer around COVID in countries like Spain and Italy, despite they've been hardly hit by the pandemic due to the very simple reason that these blue bars essentially reflect the level of buffer rates which is there to address domestic cyclical risks, which is calibrated based essentially on the impact of the DSRI. And in those two countries, essentially in that part of the sample, when we arrived to the COVID pandemic, the domestic cyclical dynamics were really subdued. And that's why you observe a zero level of buffer. And this is why they arrived also, as a matter of fact, to the pandemic without any CCyB in place. So I hope this kind of a bit clarify the points. This is 2 points that I wanted to clarify. So quickly on the other questions. So thanks a lot. They're all very useful. So on the cost benefit analysis, yeah, this is a great point. Actually, we want to work on it. So we didn't look into it, and but we, the idea of this very simple build-up rule is exactly that. You mentioned that, yeah, it's costly because you have to essentially build up equity and increase equity. But the idea of the build-up rule, which is very simple and very stylized, is exactly that. Essentially, you go and increase the CCyB capital buffer when you have high profits, because in theory, when you have a high level of profitability, you don't have to raise new equity. And this is exactly the idea behind this very simple rule. So this makes exactly this makes it less costly to build up the rate. So we do not really quantify cost and benefits explicitly, but we try to minimize the costs through this illustrative example of build-up rule. But it's definitely something that we want to look at in terms of having a more extended framework for cost-benefit analysis. So in terms of, okay, if the CCyB increase the incentive to take risks because it's the same across all banks, I think this is a bit more a higher level questions compared to the paper. It's the CCyB is a macroprudential measure, and as such is designed to be implemented in the same way across the whole banking system. This is the way it is designed. So I honestly I don't know if it increases like the incentive to take on more risks because it's obviously it's the same rule applied around different banks. So. But it's I don't know. I didn't think about it, to be honest. But it's a very very interesting point. And so the framework we have in terms of for the sensitivity of the different risk or interest rate environments, we do not look into this dimension. We haven't looked at the sensitivity in different states of the world, but it's a very well taken point. Thank you. And then finally on losses, so we take the ROA. So when we talk about losses, it's like the left side of the distribution of the ROA. So negative realization of ROA essentially. We do not. This is the way we look into losses. But if yes, this is whenever it's recorded in the balance sheet, in the profit and losses account. So I don't know, but yes, and also to whether there is this. We didn't look into the constraints on other measures like leverage ratios and so on when there is the release. This, as I said, the build-up rule for release and build-up is just. It's not really the focus of the paper. Thank you.
Thank you very much. So I would like to declare close the session. So let me applaud all the speakers.